Chapter 13, Building the Price Foundation. In this presentation, we will focus on parts of Learning Objective 1 and Learning Objective 2, which are to identify the elements that make up a price and recognize the objectives a firm has in setting prices and the constraints that restrict the range of prices a firm can charge. So one of the first things we're going to take a look at is the nature and importance of price. The price paid for goods and services goes by many names. You can hear price in the terms tuition, rent, interest, premiums, fees, dues, fare, salary, commission, wage, and sometimes they will label it as price, but all of those terms mean the same thing. They mean what is the price that you are paying for goods and services. Pricing decisions, as I noted before, involve carefully assessing consumer demand, revenues, fixed costs, and variable costs before setting a final price. Pricing is unique among all marketing and operating factors, and it's the place where all other business decisions come together. Because if you think about it, when setting a price, customers have to be willing to pay it. It has to generate enough sales dollars to develop, produce, and market a product while still earning a profit for the company. Very small changes in price can have big effects on both the number of units sold and the company profit, and this is huge. A 1% price increase translates into a 12% increase in profitability. So that small percent increase in price can yield a very large increase in profit. So, knowing a little background, what exactly is a price? Well, price is defined as the money or other considerations, including other products and services, exchanged for the ownership or use of a product or service. Now, companies can use pricing. Sometimes bartering is used, which is also considered part of the pricing model. Bartering is the practice of exchanging products and services for other products and services rather than money. And bartering accounts for billions of dollars annually in domestic and international trade. So one product being exchanged for another product would be a barter. A product being exchanged for money would be looked at as pricing. Okay, the amount paid for a product or service is not always the same as the list or quoted price because of discounts, allowances, and extra fees. And these discounts, allowances, and rebates can make the effective price of a product lower. What many firms have started to do is they lower the price of their product or service and then they charge special fees and surcharges rather than a higher list price. This practice is driven by consumer zeal for low prices. So basically what's happening is the customer would rather see a low price and pay special fees and surcharges rather than pay a higher list price. And this is the ease of making price comparisons on the internet. Buyers are more willing to pay the extra fees than a higher list price, and sellers use add-on charges as a way of having the consumer pay more without actually raising the list price. So all of these different factors that increase or decrease the price come together in what's called the price equation. So if you look at the slide on the screen, it gives you the price equation. So the final price equals the list price minus any incentives and allowances plus extra fees. So this is the equation that companies use to come to the determination to figure out what the final price for a product is going to be. Figure 13-1 provides an example for you of how the price equation works. So if we look at the second one, for example, a term in college bought by a student, the final price, called tuition, equals the published tuition, so whatever they state, minus any scholarships, other financial aid, or discounts for number of credits taken, plus any special activity fees. So when you take all those things together, that gives you your final price. I would encourage you to pause the video here and take a couple minutes and look over the pricing equation for the three examples provided: a new car bought by an individual, a term in college bought by a student, and merchandise bought from a wholesaler by a retailer to determine how they compute their final price. And throughout the course, one of the things that we've talked about is how the pricing and features and functionality of a product provide value to the consumer. Well, price is an indicator of value, and price is often used to indicate value when it's compared with the perceived benefits of a product or service. So again, we're comparing the price to the benefits of the product or service. Specifically, the definition of value is the ratio of perceived benefits to price. So the equation for value is perceived benefits over price. For any given price, as perceived benefits increase, value increases. Conversely, for a given price, as value decreases, perceived benefits decrease. And we've talked about this. Higher price usually indicates or yields higher value, higher quality. Lower price yields lower quality, lower value. Creative marketers, what they do is they engage in this process called value pricing, which is the practice of simultaneously increasing product and service benefits while maintaining or decreasing the price. So they're increasing the value while keeping the price the same or decreasing the price. In a survey of buyers, 84% agreed with the statement, the higher the price, the higher the quality, and that's something that we've talked about consistently over the course of the semester. Value involves a consumer's judgment by regarding the worth and desirability of a product or service relative to substitutes that satisfy the same needs. So they're making a comparison. Value is part of that comparison. A reference value compares the costs and benefits of substitute items. And as consumers, we do this all the time. We compare the value, we compare the price to determine if we are getting the most bang for our buck. So then the question becomes, how does pricing impact the marketing mix? Where does it fit? Well, pricing, as we know, has a direct effect on a firm's profits. And we look at the profit equation. Here we've talked about how to calculate profit before, revenue minus expenses. So the profit equation is total revenue minus total cost. Total revenue is found by multiplying the unit price by the quantity sold. Total costs are calculated by taking the fixed costs and adding variable cost. Fixed costs are costs that remain constant. Variable costs are costs that fluctuate, and that can depend on quantity produced, quantity sold, and then you take that revenue and subtract out the total costs. So the quantity sold affects cost, since the quantity sold impacts the firm's cost due to efficiency of production. So it's important to note that when determining the profit equation and looking at the process as a whole, there are actually steps in setting a price. This isn't something that they just look at kind of willy-nilly and say, oh, we're going to set the price at $4.99 or $15.99 or $24,999. There's an actual process in setting a price, which we'll take a look at on the next slide. So if you take a look at figure 13-2, this graphic represents the 6 steps in the price setting process. The 6 major steps involved in the process of setting prices are 1, to identify pricing constraints and objectives, 2, to estimate demand and revenue, 3, to determine cost, volume, and profit relationships, 4, to select an approximate price level, 5, to set the list or quoted price, and then 6, to make special adjustments to list or quoted prices. For our purposes here, we are specifically going to focus on step 1, setting pricing objectives. So in the price setting process, a marketing manager must consider the pricing objectives and constraints that will narrow the range of choices. And it's important to note here that pricing objectives frequently reflect corporate goals. So the different pricing objectives we're going to take a look at are profit, sales, market share, unit volume, survival, and social responsibility. Many of those should sound familiar to you because back in Chapter 2 on pages 30 and 31 when we talked about corporate goals, okay, there are quite a few of them that line up. For example, profit, sales, market share, social responsibility. Okay, so pricing objectives frequently reflect corporate goals. It all has to support each other in order for it to be successful. So let's take a look at our pricing objectives. Okay, pricing objectives involve specifying the role of price in an organization's marketing and strategic plans. Pricing objectives are carried to lower levels in the organization, such as in setting objectives for marketing managers responsible for an individual brand. Pricing objectives may change depending on the financial position of the firm, the success of its products, and the segments it targets. An organization may pursue 6 broad objectives, which I have already noted. Again, also see Chapter 2, pages 30 and 31, that tie directly to the organization's pricing policies. So the first thing that we'll take a look at here is profit. Okay, we already identified profit as revenue minus expenses. There are 3 different objectives that relate to a firm's profit, which is often measured in terms of return on investment, or ROI, or return on assets, ROA. Okay, so first they look for managing long-run profits objective. A firm gives up immediate profit to achieve a higher market share as it develops quality products to penetrate competitive markets. The products are priced relatively low compared to their cost to develop, but the firm expects to make greater profits later due to its high market share. Okay, so they're looking for profits here in the long run, not in the short term. And if you remember the discussion and when we talked about Amazon and we watched the video and their segment on 60 Minutes, their focus was long-term profits, not having profits happen right away, but managing their pricing structure so that they benefit in the long run. Another part of the pricing profit objective is maximizing current profits. So this could be maximizing profits for a quarter or a year. It is common in many firms to maximize current profits because the targets can be set and performance quickly measured. U.S. firms are sometimes criticized for this short-run orientation. So where Amazon focuses on the first objective of profit, managing for long-run profits, other companies focus on managing for current profit. And then last but not least, they're looking at target return objectives, which is your return on investment. And this occurs when a firm sets a profit goal, such as 20% for its return on investment before it pays taxes. So all these three things are part of profit, and the company has to set their objective to determine which focus they're going to have. Are they going to manage for long term? Are they managing for short term? Or are they looking for their target return on investment? The other objectives that can be looked at in identifying price are sales, market share, unit volume, survival, and social responsibility. Sales is another objective that may be used to increase sales revenue, which in turn will lead to increases in market share and profit, so they all relate to each other. Pricing objectives related to sales revenue or unit sales have the advantage of being translated easily into meaningful targets for product or brand managers. Cutting price on one product in a firm's line may increase its sales revenue but reduce those of related products, so they have to do a comparison to see if it's really going to make a difference. Market share is another pricing objective, which we spent quite a bit of time talking about in Chapter 2. And just as a reminder, market share is the ratio of a firm's sales revenue or unit sales to those of the entire industry. So they're looking at competitors plus the firm itself. They can look at this as a pricing objective, and companies often pursue a market share objective when industry sales are relatively flat or declining. So they want to know where they stack up, and they base their pricing based on what the rest of the industry is doing. Another pricing objective they can use is unit volume, and this is the quantity of products that are produced or sold. Firms often sell multiple products at very different prices and need to match the unit volume demanded by customers with the price and production capacity. Using unit volume as an objective can be counterproductive if a volume objective is achieved by drastic price cutting that drives down profit. So there has to be a balance, okay? They can't price cuts or drastically cut prices to increase volume if there's not going to be if it's not going to be profitable. So they have to balance that. They have to do that. There's a very fine line there. Another pricing objective is survival. At times, survival is the only objective to consider. So when you have a product that has low prices have to generate revenues to improve a firm's cash flow. If the firm can't match price cuts by its rivals, then it's not going to survive. So that's something that they also have to think about. You know, if you have a product that's a competitor and your competitor is chopping prices and they're increasing volume and they're increasing sales and people aren't buying your product anymore, that pricing change might need to be set just for your company or your product to survive. And then last but not least is the pricing objective of social responsibility. Okay, and with social responsibility, we also talked about this quite a bit in Chapter 2, and we took a look at Ben & Jerry's and how they function as a socially responsible organization. A firm may decide to forego higher profit on sales for a pricing objective that recognizes its obligations to customers and society in general. So they look at it and say, okay, we want to sell a product, we want consumers to be able to purchase our product. We don't want to price it so high so that it's not being socially responsible. For example, a product that consumers need to purchase, like things that are necessities like food and things like that. They still have to be able to price them in a way that consumers are going to be able to go out and purchase the product without breaking the bank. So pricing also falls into the category of social responsibility to make sure that they are fulfilling obligations to customers and society in general.